Welcome to another edition of the Brooks Macdonald podcast. I'm William Hobbs, the Chief Investment Officer, and for this episode, I am lucky enough to be joined by a legendary, multi-award-winning superstar tech investor, Ben Rogoff of PolarCap, who's blushing prettily for the cameras. We're going to chat today, obviously, about tech. It would be a bit unfair to hit Ben with something else. But really all the goings on in artificial intelligence and sort of some of the threats and opportunities that still remain in this space. Now, Ben, welcome, first of all, and thank you for joining us. Hello. So first of all, if you don't mind, I'll sort of try and set the scene a little bit with kind of what we're thinking a little bit about, and you can pick holes in it and we can sort of take the conversation from there. So as I see it, generative AI, it doesn't have to be seen as a kind of rupture out of the blue in some ways. As far as I'm concerned, it is part of the wider information revolution that started in the mid-90s. We have obviously during that period digitized vast tracts of physical information. We've developed algorithms to try and make sense of that information. And in a sense, generative AI is the latest kind of bit in that process. Now, the thing that I guess we're looking for, and part of what I'm interested in this discussion, is the really exciting bit for historians of technological change. And I know you and I share that passion. You know a lot more than I do.
No, but we do definitely share the passion.
We share that passion. But it's really about the moment when you get process change. And the example we always use to, on this podcast is the idea of electrification. When you switched from steam power to electric power, the electric dynamo in the factories. And it took, the first generation of factory managers, so I'm not teaching grannies to suck eggs here, but this is just a reminder for the listeners. They simply switched one power source for the other. It took the next generation to reorganize the factory's processes around this more flexible, safer power source. And that was when you get the production line and all the amazing productivity gains that happened afterwards. The same was true with digital computers and all that kind of thing. So I guess what's stopping that moment? Where are we now in that whole process? Pick holes in it.
No, I think it's the right framework, and I mean the electrification is one of the electrification period and how long it took for sort of change to show in macro data, and these are some of the things that we've also been wrestling with, and I think it is the right parallel. So I think I suppose on one level, it's sort of salutary in that it will take longer, therefore, for AI to have the sort of macro level impacts that people are hoping for, expecting. Again, it's important for me as an investor to be able to divorce that from stocks.
Yes.
I'm pretty sure that by the time that Gen AI or AI turns up in macro data, the investment trade will have had its best years. So I don't think the two things are synonymous. I do think that there is going to be invariably a gap between the sort of micro or sector level productivity that you're maybe beginning to see and discuss and the macro data. Even in things like labor markets, where anecdotally, youth unemployment is challenging. Parts of India, political change in India on the back of unemployment that they're just not used to, as a result, probably at least in part from Gen AI. So you are beginning anecdotally to see the impacts, but obviously, actually, in the US, for example, the labour market is pretty strong. So I think there will be a gap, and the question is really around how long does it take for organisations to make changes. The change management is really the gating factor at this point, because I think models have already reached levels where they are having a demonstrable impact in organizations. So it's not the model.
So do you think it's the data? Do you think so? That seems to be one of the sort of problems that people talk about a little bit, is that, enterprise data, we just haven't got used to organizing it correctly, or we're not asking the right questions.
I think so. That's definitely one of them. I think in the end it comes down to kind of QA, quality assurance, reliability, verification. These are the things that would have been true for trucks over horses, or various other times. So this truck thing looks really impressive, but it actually breaks down more than the horse.
Yeah.
We don't have the infrastructure we need, unlike say stabling that we've had for 50, 100 years. So I think that at the moment, a lot of the quality assurance and verification, which is critical, obviously, in a world where AI isn't just doing is doing repeatable tasks, and therefore, at the moment, it does feel like human in the loop is still the primary way to verify AI output, which is not going to, in the end, wash. So we're going to have to find ways to verify, and I think all of the model makers and many of the software companies still see themselves as having a role in that.
And do you think, is there sort of like the hallucination issue? Is that something, how, and I guess this is again, going back to another example of, technological change, the mobile telephone and the famous AT&T report, which sort of imagined, what was it? There'd only be 100,000 phones by the millennium, and it was 10 times that.
Yeah.
And it was a totally understandable mistake from the advisor, McKinsey it was, I think, without calling them out badly, but it was an understandable sort of a short cast, because at the time batteries were too big, all these kind of things, the problems, you just couldn't see what problems were going to melt away at the hands of kind of, all of the might of human power that was kind of being drawn to it. Where do you think the problems are in AI, and hallucinations being one of them, that are most likely to melt away in the path ahead that'll give us the sort of the enterprise?
I mean, they're already melting away, aren't they? I think going back to the original question about, timeline to, I don't know, mass adoption is probably the wrong term, but to a point where AI is everywhere and visible, much like electrification. I think we've all become trained for things to happen yesterday, and again, the younger you are, the more you feel that. And let's just not forget that the first ChatGPT is November 2022. It's not very long ago that the world as we know it was sort of turned upside down. And here we are with, I don't know, 1 billion people on OpenAI. So things have moved pretty fast already. To the question on hallucinations, I mean, just think how far we've come in that regard. The very early models were sort of making stuff up all the time. Failure rates or error rates, I think the term is, again, we're probably high single digit, maybe higher than that. And there are still a lot of people out there that are still fighting that fight around hallucination rates. Sorry, that sounds like I'm being rude because you just referenced it. But again, if you're not using the latest version of either a Claude or OpenAI ChatGPT, then you're probably still feeling that. But if you are at the frontier, if you're using products today, it feels to us like when you look at the actual benchmarks that matter, that those benchmarks certainly the early ones have all been saturated, so solved. Now I don't think that it is the error rate that has really very much to do with anything. I think we are now at the pre-agentic AI period has ended. We're now at a point where AI is able and capable of being able to compound and do tasks, many step tasks, in a way that was just impossible to imagine a few years ago. So you probably obviously know this statistic, but how long can AI operate without a human in the loop as it relates to software coding? And the duration of that used to be seconds. And now we're into the hours. I mean, many hours. And that is what's making agentic possible. So I don't think that's what requires. And I think we've already made enough gains there. Obviously, if you're an AGI bull, the idea that we're going to, agentic is just a waypoint. And really, it's a critical one for an enterprise, because in the end, repeatable agentic tasks are the things that AI can substitute for labor. And again, we can come back to that. But I don't think that's what we're trying to solve for at this point. I do think actually it's more about how can we embed that into organizations. And I do think we're still very early, which we're trying to force AI into workflows that were built for humans. And that will take longer to obviously resolve.
Yeah, and like you say, that's just experimentation and trust and verify. Now, just sort of flipping the conversation a little bit and thinking about, the delivery of the frontier of sort of AI. The unit economics look quite difficult at the moment, in terms of making money out of this stuff. Where do you see that evolving, and how do you see that evolving? What's the kind of...
difficult for who? I guess the first question would be difficult for who? If I haven't seen the full financials of Anthropic, but I imagine they're pretty attractive looking numbers, and no precedent for a company growing like this on Earth. So you're in a pretty special moment when you see the revenue ramp of that company.
Yes, I guess my question is more about how many can make the sort of big market idea, and the idea, I guess we get to SpaceX as well, with regards to, you're now seeing them rent out energy to others. Right. So, how many can make money out of this? It's the poker table kind of idea.
Life is lots of things, but it doesn't necessarily have to be fair. And I think that the idea that somehow AI is a democratizing technology where everybody ought to benefit is one potential take on it.
Yeah.
But that, you could argue that Google has been one of the most incredible democratizing, companies, technologies ever created, and yet Google is making most of the search revenues. And so I think, I think the economics are challenging because this is an industry that's capital intensive, requires a lot of capital, not just to train the models, but obviously now we're into the more of the inference era. There's a lot of capital required. And, one of the challenges that repeatedly reasserts itself during periods, particularly when interest rates are high or there's some other sort of setback in the market, is that the sector's need for capital. And the numbers are very big, and models improve, they double, but for basically an order of magnitude more capital. That isn't an easy thing to get one's arms around, and as a percentage of GDP and any given snapshot. So I mean, I don't know. I think that the economics are challenging because we're in a sort of it's a brand new era, isn't it? And what appears to then sort of rhyme with the dot-com period, which has been true now for the first 3 and a bit years of this investment cycle, is that there are facets of this investment cycle that do look a bit like what we did when we built out the commercial internet. And yet in time, no one really is upset about the unit economics of the internet. We created a software industry on the back of it. We have smartphones that replaced that brick and whatever it was before, and all of that sort of sitting on top of the infrastructure that we started building out in the mid-90s. So I'm very confident. And then you look at things like token economics and how fast token prices are falling, but also what you can do with that token now, given that AI models are so much more capable than they were 3.5 years. So I think the challenge here is that the world that we have right now is a world where the economics of this industry are dominated by two groups. One of the groups is very, very small number of companies that are at the frontier of model development. And then there's the other much larger swathe of companies that are helping them. They're the beneficiaries of the capex of those companies, but also other companies too, like the hyperscalers, that are trying to, I suppose, remain relevant as we move from an internet first world into an AI first world. So for everybody else, the hope is, of course, that AI will become commoditized like steel, like electrification, like electricity rather, and it will be a commodity input that we can plug into our businesses and happy days.
Yeah.
That's not the world that we're in at the moment.
No, that's true. So just before I ask this next question, I should have done this a little bit before I ask that question, but just a reminder to listeners, any stocks recommended, any stocks I say mentioned rather than recommended, it's not recommendations, these are illustrative,
100%.
That's not part of this podcast. We're trying to
very much a reference to Google of the past.
Absolutely.
And definitely no recommendation.
No, we get in trouble for that. But super interesting. So I guess also just another thing that we've been thinking about a little bit in terms of, because you're talking a little bit about the picks and shovels phase. And the sort of big waiting question mark is really when you move into the next. And I guess it goes back to that process piece. But I guess my theory would be is that if sort of AI is reaching its potential, then it's the knowledge economy and knowledge intensive areas like the UK stock market to a degree, and some of the other areas that should be sort of key beneficiaries. Are those areas you look at within your kind of framework, or are you really focused on the first bit of the sort of technological
It's a great
change?
question, and I think there has to be a handover, doesn't there? There has to be value add outside of just the companies selling, the tokens, the frontier model guys. And so, I think when this investment story first really broke out, if you look at all of the various ETFs that were created by various different banks, the early expectation was that there would be beneficiaries from day one that weren't infrastructure players. And actually they've been very hard to find so far, because the profit pools of a pre-AI era are in flux. Yeah. Much of what a software company does is now, or certainly the guts of it, the kernel of what a software company does, codify best practice, is something that you can now spin up on the fly using a large language model. And I think that so far at least, finding the beneficiaries within a technology universe has been pretty problematic. And again, some of this, most of this, of course, is narrative. It's the terminal value risk that's turned up in various sectors has been even greater than perhaps we had anticipated. And so in a world where models are scaling at a frankly unprecedented rate, we've never seen improvement like this. It puts Moore's law to makes it look embarrassingly slow. And when you're in that world, it's very easy to extrapolate, of course, and then find a bear case on just about anything that existed in a pre-AI world. But and of course that's unreasonable. Yeah. But in the fullness of time, it may not be. And the world of Steam. There probably weren't very many things that you could be confident in 100 years later, and I feel like that's the same today. So actually, what we've been doing, without talking stocks, is actually we have we run 2 technology funds. We had done for a very long time at Polar, but we also about 8 years ago launched an artificial intelligence fund, which is a global equity portfolio. And again, without going into details, our sense is and was that there would be beneficiaries from an investment perspective that fell outside of the remit of a tech investor. So we're obviously looking for beneficiaries everywhere, but it does feel like there are less profit pools outside of the tech sector that at risk, perhaps, at least at today, from generative AI. And so we're looking at areas, I mean, real assets, for example. I think companies that own physical assets are interesting in a way that they haven't been, perhaps, in a world where a large amount of the value add has been captured by digital platforms that have been monetizing attention-scarce humans. In a world of agentic, does the power shift back to the asset owner? And if that's true, then perhaps an airline or, I don't know, a cruise company or something could be more interesting than they've looked in years. So this idea of digital abundance, anything built on code is now commoditized in the same way that agricultural mechanization in the 19th century, what that did for wheat prices and wheat output. Like, we could have digital abundance, and juxtaposed against physical scarcity is sort of the framework that we've been using for a while now.
How interesting. And two more questions that just popped into my head while you were talking. Just in terms of sort of your job and the team's job, and thinking about, the emergence of winner-take-all markets, which is a relatively new phenomenon. Does that also bias you? I mean, looking at the US stock market now, these are new, young companies.
Right.
Does that also, that's a good thing, but it also, from an analytical perspective, does that increase more model risk for you? Are you having to be more aware that what can come so quickly can also go quite quickly?
The impermanence, I think, has obviously been has become better understood, I think, and just the length of time that you spend in the S&P, for example, as one proxy for that. So yeah, I think that very much has featured into how we've invested for a long time. And again, I've been looking after client money at Polar for 20 plus years. And during that time, Nick Evans and I, who co-managed the team, we're reasonably high turnover investors. We have again, I probably shouldn't say it out loud, but we are FOMO in a sense that you can't afford to miss big winners in a sector where, as you say, returns are concentrated around a handful of, dominant industry winners. So live paranoid, make sure that you don't miss those companies. And occasionally, for example, in the past, Tesla, which was a stock that challenged our investment approach in terms of its sort of, I suppose, its profitability in the early days. We were relatively late to, because it didn't fit well into the world that we or our investment process. But again, eventually got there because all of the value to the electric vehicle industry is sort of gravitated towards Tesla. It's been much harder for the the existing automotive companies to reinvent themselves from combustion engine to electric vehicles. So yeah, we absolutely have a fear of missing out. We also are very alive to the lack of mean reversion in the industry. So not only so once you've identified that a company isn't going to be one of those big winners, then you should treat it very differently to one of the companies that is. And therefore, you should be much more willing to potentially recycle that capital, top of the funnel, and look again for that next wave of winners. And that is a very different investment approach to, I suppose, what is probably normal outside of an industry like ours. Interesting.
Healthcare is one of the areas where people are very excited about already what generative AI can do.
Sure.
Are there any sort of things coming out of that space where you're seeing sort of, particularly exciting developments? And is that something you're...
Yes. It's a place that we read about a lot. Obviously, Dara Amadei talks a lot about the potential here. And I think that if you're, as we are, bullish on this idea of accelerated discovery, a century in a decade or a decade in a year of progress, then naturally you're going to end up looking at areas like healthcare. And, again, I think things like agricultural mechanization, one of the positive externalities that came out of that, of course, when you write a piece about the labor market and I'm sure how many, people lamented the loss of, jobs associated with the land, but failed to recognize that life expectancy increased by 20 years within half a century. And so how can you not be excited about the positive externalities of AI, even though the narrative against it is all negative? It's all about, risk and jobs and what people do, but no real, very, very little mention of what positive externalities and where would they show up? And they would almost certainly show up in things like healthcare, longevity, the chronic, how we manage chronic disease, how few proteins have ever or compounds have ever been discovered, how little we know about domains like, within healthcare particularly. And so, but at the same time, we are investors and we're looking after other people's money. And so we have to do battle on high ground wherever possible. And, we have a very capable healthcare team at Polar, and I wouldn't want to do battle with them. I also would step back and say that the timeline for a lot of the breakthroughs may disappoint. We don't know. So I think you can be excited about this sort of new frontier and what we might discover and how little we once knew about something, and still be relatively careful about how you would invest there. And, we will have a moment. This is what's so fascinating about the AI story, is that, we're sort of, we as all investors do, you have to grapple with the kind of current narrative, around the puts and takes of AI. And I understand that. And But of course, there's also a bull case where one day you do come to work and someone has had a breakthrough in a way that it's a drug discovery that is pure AI driven, or something has come about in a way that is genuinely transformative. And, I don't know, maybe it's the Ford Model T, that the moment where you realize that oil is going to transform transportation in a way that nobody could have anticipated previously. And so we haven't had one of those yet. No. That is likely to turn up in a healthcare domain, I would imagine.
I mean, you could sort of say that the protein folding breakthrough is the equivalent of the cracking of the periodic table. Nice. And after that, you get all the chemicals that come off the back of that, and sort of all the sort of revolution.
It's a great example.
It takes a while, doesn't it? But
it does. And I think from an investment perspective, certainly, going back to the idea of impatience, I think that, the time from sort of discovery to doctor's office is a relatively long one in healthcare relative to some of the other sectors that we invest against. If you look at what's happening in, say, for example, where there is genuine labor market disruption is happening in areas, like software, for example, where you've seen a large number of companies doing very significant, sized layoffs. That speaks to the fact that that's a world where their businesses are built on code, and now we have AI that can write code in an abundant, cheaper way. And so, again, you're seeing it turn up there much faster. So I think that you're right. I mean, we have already seen progress. I think that it's not like that. I'd read this somewhere. The idea that somehow humans have picked all the low-hanging fruit it seems highly unlikely. Laughable. In the world of AI. We've barely entered the orchard, I think, is a better way to think about it.
No, great. One last and short, brief answers from you. Thing you're most excited about, thing you're most worried about at the moment in markets?
Well, I suppose the most excited about is that this idea that we're very rapidly, AI scaling is really quite unusual, and excited about the fact that the current debates all seem to be still very much either rear view mirror or at best sort of current. I don't know, what will people do for it? Understandable concerns around AI. It's always the negative narratives around disruption, and disruption always turns up first. So we're excited about the fact that there's still an awful lot of skepticism about this, or how long can AI models continue to improve? And again, I think that's unlikely to persist as this cycle continues. If we're right, we will get to that point in a cycle, of course, where everybody's a believer, and that this was, so that's exciting, and just watching how fast technology evolves and how it melts the sort of the bear case around it. That I suppose what we're concerned about, I wouldn't want people to extrapolate, returns that we've been able to achieve, and I think that somehow this is a sort of normal annualized rate of return. We've had an incredible period of time with this year, particularly 2026, where the macro backdrop's been challenging, and yet a lot of the AI engines have worked because we've had this explosion in agentic AI, and understand that that this is a fairly unusual period, and that if you go back to the 90s, when we were building up the commercial internet between 95 and 98, we had 7 setbacks of 15% or more during what was a very good period for overall return. So volatility is something that people should be alive to. We're obviously always worried about because we're trying to look after people's money. So I think, and then finally, I would say the only other upside or other risk that we should talk to very quickly is this idea of upside risks. Models improve to a point where we saw recently with Fable 5, and also allegedly with the newest of the OpenAI models, where the US government is wanting to have a look at what it is that we're releasing to the world. And I think that that's something that we should be mindful of, because we've likened this period to a race. It's a race between frontier companies. It's a race between the Anthropics and OpenAIs, but also the hyperscalers to have the best model. Because at the moment, the best models are generating nearly all of the revenues. And our view has been to the victor, the spoils. That ultimately, who wants to use a model that's half as good as the one that's the most expensive? That so far, at least, happens a bit. The other race we're waging or whatever is a between countries, between nations. And I do think that that's been a incredibly important observation, because it's very easy to spin up a world where the US government is intervening and what have you. But if the greater story, of course, is a race versus China, then the chances are we could be relatively sanguine about the risk to the AI story. But it is certainly something that does feel like we've now reached a point where there is the beginnings of intervention from what has been a very supportive US government and surprisingly, actually, for some people, how supportive the Trump administration has been for AI. So I think that's something to be alive to. But overall, it's good as an investor, at least, to have some stuff to worry about.
Always, Ben, that was brilliant. Thank you. And just as a sort of roundup, so Ben and his team, Ben, Nick and the guys, they are a great example of how the industry can provide ways of actively focusing on certain parts of the market, and particularly during an industrial revolution. That kind of active exposure and picking stocks is a really interesting way. We would also say that should be done as part of a broader, that kind of active exposure should be done as a kind of broader net, where you're designing a multi-asset class fund or portfolio in order to try and capture the gains of the full industrial revolution. That's really the sort of the key, because as Ben points out, the gains can crop up in some unexpected areas. You want to augment that sort of tailored surgical exposure with exposure to the world economy. And if you're during an industrial revolution, you don't know quite when the gains are going to show up, but you're really trying to take an optimistic view on long-term global growth. That's the point of investing. And there's a patience angle. And I would argue that that's almost the best way to think about some of the healthcare thoughts that Ben had, in terms of longer lives. All of those kind of benefits, those ultimately show up in investment returns, but unevenly and over long periods of time. But thank you very much for joining us. We'll look forward to seeing you next time.